By downloading or listening to this podcast, you are agreeing to Moody's legal terms and conditions found at moodys.com/disclaimer, including that the information provided is not investment or financial advice, and that Moody's will not be liable for losses arising from your use of the information.
I'm Danielle Reed, and this is Moody's Talks, Focus on Finance. Today, Moody's banking team analysts Steve Tu and Alan Tischler are here for Fast Finance, where Moody's analysts give their credit views on topics in the news. Steve, welcome back.
Thanks, Danielle. Glad to be here.
So, Steve, a couple of episodes ago, you were here to talk about artificial intelligence, or AI, and its impact on banking. And now I understand you have some news to report about AI and Klarna. First of all, what's Klarna?
So Klarna is a fintech. It's founded in Sweden. So it's a global online retail bank, does payments, shopping services, and it's probably best known as one of the pioneers in buy now, pay later, BNPL. Okay.
And what is the news about AI and why did you notice it?
Yeah, so they recently announced that their artificial intelligence customer services agent, which launched earlier in the year, handled 2/3 of its customer service chats within the first month of operations. And the kicker is they expect the AI assistant will lead to a $40 million profit improvement in its 2024 financial results. And I guess, the reason it really caught our eye is, when you talk about a lot of these big disruptive technological changes, and this could, probably be the very biggest one that we will experience in our lifetimes, especially when you're talking amongst credit analysts. First it gets debated, well, is this for real? Is it not? Is it a hype cycle? Is it a fad? Okay, but let's say you move beyond that and you agree it's real. Then it's like, well, is it credit material? Credit analysts tend to live in the here and now as opposed to, when you're thinking about equity in the future, growth potential, we're really focused on, what's happening right now and is going to have a real material financial impact. And then, so, that kind of is the bargaining and debate. But then let's say you get beyond that, then it's like, well, is it going to have a material credit impact, in 3 to 5 years, or is it going to be like 5 to 10 years? But here, with this Klarna announcement, and what the company is telling us, here you have something that's really transformative. It is having a material credit impact, and it's happening right now.
Okay, so I get that. And you mentioned a minute ago, a $40 million profit improvement, and that's pretty big. Were they profitable before, though? How do you put that in some context?
Yeah, so they've been profitable in the past, but to put it in context, they did report a loss last year, $242 million. So $40 million in the context of $242 million lost, it's a fairly sizable figure for them. So,
tell me more about this new AI assistant. What exactly did it do?
Yeah, so Klarna said that the AI bot processed 2.3 million conversations, which the company estimates is the equivalent work of about 700 full-time agents. And it, handled a range of tasks, from simple stuff all the way to things like processing refunds.
And okay, so that's like something beyond, please tell me what my balance is or something like that.
Yeah, and they also did say, the customer could also choose to get transferred to a human at any time at their request. And so a lot more complex tasks that you might be used to from older customer service chatbots, this seemed to have done stuff beyond the typical tasks. And it also seemed to be pretty efficient. It resolved tasks for customers within an average of less than 2 minutes, down from the company's estimates of 11 minutes previously.
And I'm guessing the bot doesn't need vacation time.
Yeah, that's probably a fairly good assumption. And, the fact that it's 24/7 probably also leads to less hold times. And, that plus the ability to, converse in multiple different languages probably also led to, improvement in customer engagement.
Do you think there's any, broader takeaway from Klarna's AI experience?
Yeah, I think, the real thing, the real significance of this news is that some of these things that people are thinking could be far off into the future, could be happening a little bit closer to the present. And, I think it's, banks in particular that are willing to rethink traditional business processes and kind of take a more AI-centric approach. They may be able to see the benefits from AI rather quickly.
Steve, thank you so much. And we're now joined by Alan Tischler here to talk about a disclosure Wells Fargo just made in its 10K report for last year and what clues it holds for commercial real estate, particularly the office segment in the U.S. Alan, hi. Welcome back.
Hi, Danielle. It's great to be here.
So, Alan, tell me about what Wells Fargo disclosed and why do you think it gives some information about what's ahead for banks with loan book concentrations in U.S. commercial real estate? And just before you answer that, spoiler alert for listeners who haven't read the report, although this is not really a surprise to anyone. One main takeaway from the report is that banks expect property valuations to go down in the U.S. on average.
Right. So Wells Fargo disclosed some helpful information that few banks do. Specifically, it included some key economic variables that it used to determine its loan loss allowance at year-end 2023, which we found to be pretty insightful. Specifically, it disclosed that its current loan loss allowance incorporates a 14% drop in commercial real estate asset prices in 2024, and that's more than double the 6.7% drop in 2023 commercial real estate asset prices that Wells Fargo used in setting its 2022 loan loss allowance.
Okay, got it. Yeah, more than double. So that's an increase. So Wells Fargo assumed a 14% drop in commercial real estate asset prices this year, and that's an average, I guess.
Right. The 14% decline in commercial real estate valuations is a national average that varies by geography and property type. Now, it's important to note that the 14% figure is not Wells Fargo's base case, but a weighted blend of its base and more pessimistic scenarios.
Okay, still, what does a number like that mean for Wells Fargo or, for other banks for that matter?
Well, it means that Wells Fargo expects challenges from many of its commercial real estate borrowers, and that will inevitably result in some loan losses. But Wells Fargo and the other large and more diversified U.S. banks have relatively modest commercial real estate exposure, which gives them the ability to absorb high commercial real estate credit costs without materially weakening their overall credit standing.
What about smaller banks?
Well, smaller banks, many community and regional banks, tend to be more concentrated commercial real estate lenders. So if commercial real estate credit costs were to go significantly higher, that would have a bigger impact on their profitability and potentially on their capital.
Are there a lot of banks that are really exposed to commercial real estate?
Yes, among our rated U.S. banks, 27 institutions have total exposure to commercial real estate, including construction loans, of more than 200% of their Moody's adjusted tangible common equity at the end of September 2023. Now, banks' portfolios of commercial real estate are not uniform, and their underwriting is not all the same. And there are differences in geography, property type, when loans mature, and so on.
Also, not all commercial real estate categories are equally at risk, maybe?
So the outlook for office valuations is especially weak. We do expect banks with large office exposures to have sizable charge-offs in the coming quarters as vacancies reduce property cash flows. And net charge-offs on construction loans are prone to significantly increase in a commercial real estate downturn as well. But we don't expect banks' commercial real estate credit challenges will be confined simply to the office and construction markets.
Why is that?
Well, there's the broader negative effect on all commercial real estate from higher interest rates. Property valuations generally will be lower, and debt will be less affordable for commercial real estate borrowers. In combination, that raises the refinancing risk for borrowers whose loans are reaching their maturity. And a final point is, in the event of an economic slowdown, commercial real estate credit costs overall will likely hit a peak a little bit after that. At least that's what the historical record shows.
Okay, got it. So there's, more to come on this, I think. Alan and Steve, thank you both so much for your insights. And thanks very much, as always, to our listeners. If you're listening on your favorite streaming platform, please remember to follow or subscribe. And please tune in again soon for future episodes of Focus on Finance.